What beginners should know in stock investing. You'll want to follow some essential investing ideas if you want to increase your money and guarantee a comfortable financial future. Many people are eager to start investing and put their money to work. However, they might rapidly find themselves losing money or putting themselves in undue financial danger. This isn't meant to scare you away from investing, it's a caution to make sure you're prepared before throwing money at assets. I've compiled a list of the greatest investing advice I believe all novices should know from the start. The most of this is applicable to the stock market, but it also applies to any other type of investing. 1. Understand why you are investing. If you don't know why you're investing your money or what your goals are, you'll make mistakes and lose sight of the larger picture. Becoming wealthy should not be your aim. Doing so will take you down some dangerous routes or force you to make terrible decisions. You may absolutely become extremely wealthy by investing, but you must have more achievable and long-term goals. 2. Never invest in anything you don't understand personally. Although this may seem obvious, you'd be amazed how easily you may fall into a trap when monetary signs flash before your eyes. I was guilty of doing this when I bought in a single stock since everyone was talking about it. I did suffer a financial setback. That was a good lesson. One of the finest investment recommendations I can provide to any newbie is to start with what you know. Read about it, investigate it, and so forth. Following the crowd blindly may strike gold, but you're more likely to lose money than gain. 3. Read investment books. The worst error you can do is to hurry into investing your money. While stock investing is not too difficult, there is a lot of information to process. Even if you're a seasoned investor, I recommend digging into some of these personal finance books and continuing to learn. I've read a few books several times and I'm still learning new things. This is also true whether you are investing in alternative ventures such as real estate, art, or websites. 4. Become defensive when individuals are greedy. Another nice segue here, while others are greedy, be more careful and protective of your investments. As I previously stated, when everyone is upbeat about the economy, investing, and talking about it, it may be time to take a step back. This does not imply that you should stop investing. However, you should be aware of and watch the broader sentiment around the stock market or economy. 5. Stay away from investment fads. That last investment advice nicely leads into this one. Avoid investment fads or when everybody is buzzing about something. During the Bitcoin craze, everyone's mother, father, grandmother, and mailman were talking about investing in the digital currency. Most individuals didn't know much about it other than hearing about people earning billionaires from it and the price increasing. That is often when it is best to sit out. 6. Do not try to time the market. I said before that you should not try to time the market. Why? Everyone, including specialists, makes statements and forecasts, but no one can truly anticipate what will happen in the market. You've undoubtedly seen the stories in the media about the market having 2 down days or other experts stating that this will be the year of the bear market. However, no one knows for certain, and no one knows where the markets will end up. Attempting to do so will cost you profits and lead you to lose money. Ignore the hype and forecasts and stick to your investment approach. 7. Be greedy while people are scared. When individuals are afraid of the markets, it is generally a good moment for you to become more aggressive. While a bear market or stock market meltdown may occur, the stock market has always rebounded. We have historical evidence to back this up. This is the moment to buy for much less and gain enormous profits as the bull market returns. While you should not sit on the sidelines the entire time trying to time the market, it is beneficial to be more aggressive when the market is down and others are scared. 8. Figure out how to read a prospectus. A prospectus is a summary of what you are investing in that is mandated by the SEC to be made available to the public. This assists you as an investor in making critical judgments concerning stocks, bonds, index funds, fund managers, and companies. This is the most important of all the investment advice. It explains what to look for, fees, information about the firm or fund, historical results, and much more. 9. Panic sales are a definite means of losing money. You often want to sell when the market is down or when you begin to notice your investment lose money. However, this is a definite method to lose much more money. It is easy to panic when everybody is afraid and the world ends in all media headlines. The markets always will rebound and you will remove your compound interest via panic sales and will cost you thousands of dollars in the future. You may wish to sell or shift money sometimes, but this should be limited solely. Keep up your investing and get the benefits for the long run. 10. Dividends and capital gains reinvestment. I strongly urge that you automatically reinvest dividends and capital gains in the early stages of investment. This assists to expand your portfolio and maintains a rising interest in you. Moreover, reinvestment enables you to purchase shares with both high and low prices, which continues to average the cost of the dollar. Eventually, if you are fired or live off these distributions, you may request the cash to be taken. Recall the tax consequences of it. 11. Your portfolio needs to be rebalanced. You will like to rebalance your portfolio as you continue to invest money routinely. In general, there is an asset allocation, which you want to keep to. However, your percentages might be offset following purchases of shares, price movements, dividends, and capital gains. How often to rebalance, but it's often beneficial to do it annually, is not exactly science. You want also to make sure that you don't tamper too much because your return may cost you. 12. Try to remove as much emotions as possible. Finally, but not least, investing in the stock market can be an emotional roller coaster, and if you are not prepared, you may make some hasty judgments. This is true in both bull and downturn markets. Allowing emotions to influence your actions might result in you losing money, selling and buying too frequently, and negatively impacting your long-term outcomes. Conclusion. Investing is a fantastic thing to do. However, in order to get the intended outcomes, numerous factors must be considered. Take care of your money, don't let it run out due to poor investments. The most essential thing to remember is to educate yourself before making any investments.